Hi, this is Randy Finney with Right Side of the Chart, and this is a morning market update for Tuesday, October 23rd, 2018. Let's take a look at the markets, what's happened today. I did one video yesterday, but I saved that for members only. I covered some levels watching QQQ, which I'll rehash here for, I'll make this a public video. I'm not going to give specific price targets on QQQ. I can't because last week we shorted QQQ up here as an official trade idea. It's been a trade idea really since the breakdown up here. But we have that on with specific price targets. So that I'll kind of give some nearby levels to watch. And of course, members of the site, I'm posting these charts, and the official targets are on the site, and I'll update that in the trading room. But let's look at what happened today. This could be that. What I refer to as the WTF moment, or point of recognition, POR, where uh, you know, uh, market participants, bulls mostly in this case, because we're having a correction, realize, what's going on? Something's wrong here. This is where, this shouldn't have happened. We bottomed last week. Everything was looking good. My dip buying went well, and now all of a sudden this big smackdown. And that is, I mentioned this in the trading room this morning before the market opened. That's typical bear market or severe correction market action. It's what I call the gap trap. And what it does is, as you know, today we had a nice gap down. Let's get rid of these lines. We've had this area of consolidation recently. The big initial sell-off. I'm still looking for that second thrust down, and you had this area consolidation, but now a big gap down. We're down 2.5% on QQQ, and what that does, it traps longs, and it also denies shorts, wannabe shorts, those that didn't have the gumption to pull the trigger. And I don't mean that in any type of offensive way or anything like that. It just, what it does, it builds a different dynamic in the market that allows for a much deeper sell-off. So if they can't recover this soon, now we still have, and I'm going to go over the micro levels here, the nearby levels to watch. There's still some support levels below, but if they can't recover a lot of this gap, one of two things is going to happen, and it may already started to happen. Stops start to get hit. Both longs that were long up here, buying the dips for years, are holding on and realize, hey, this time this was some impulsive selling. I dodged a bullet back here, or maybe those that bought in right here along in the last several months. Maybe they wanted out. They had the bounce there. But what tends to happen is once that bounce starts happening, it's human nature. It's psychology of the masses. Everything starts to look good. Oh, our correction's over. We bounced off the 200-day moving average and all these key support levels. So I dodged that bullet. And now, again, that's that what I call the point of recognition moment, where they realize, wait, maybe things aren't that well. So we'll see. There's a little more work to be done, but if we get it, and I'm correct now, the only hesitation, I would have been much stronger on my convictions heading into this week, if we didn't have, and we still do, the majority of the FANG stocks reporting, Amazon, Microsoft, Alphabet, I believe, all Intel, all this week. Those are, and I went over that in yesterday's video for members of the site. And I'm going off from memory here. If I'm not mistaken, the three that we have reporting this week, Amazon, Microsoft, and Alphabet, which are the Googles, and Intel, collectively make up 32% of the NASDAQ 100. So one third of the performance of the NASDAQ 100 is reporting Wednesday and Thursday after the bell today. So that may hold things up. But if you start having stops hit and margin unwinding, that's what I'm talking about. This point of recognition thing, and what this gap and trap does, especially if and as we continue down from here, you tend to build momentum, just like we built, I'm sorry, we built momentum. We had initial leg down, a little flagging action. We started to go, and that day, what happened there is stops just got hit one after another, margin call. Towards the end of a bull market, you have margin at all-time highs. It's just you can just Google long-term margin chart. You'll see what I'm talking about. Look at 2000, the top in 2000, the top in 2007. Investors, both professional and retail traders, become complacent, and they think the stock market's an ATM that prints cash and will go up forever because that's what the people on CNBC say it'll do, at least for another year or whatever. And so they margin up, and then when you have margin calls, you have forced selling. So that's what causes the really sharp sell-offs, and we're not there yet. We definitely had some unwinding back there. So we're close now, and what I said I'd do, let's jump into it, and I'll give you those levels. But uh, but to wrap up to that, or go back to that point I just said about a third of the market cap waiting for the Nasdaq 100 reporting this week. Those companies. Then you have Apple next week, which Apple's the largest holding, and I think again going from memory about 12%. So now you're talking close to half of the stocks will have reported by next week. So that could put it could put some a little bit of a floor in the market here until they report. If everyone wants to see what happens there, maybe the shorts are afraid to get short right in front of those big earnings reports. Maybe it's the other way around. I posted this yesterday, and I know I'm talking right now. I'm rambling on fundamental thoughts, things that I can't tell you. I can concretely tell you where support and resistance levels, key levels are on the charts, technical levels. That's not subjective, at least not in my opinion. Whereas the fundamental stuff is, and what I said recently, and I believe I said it in videos last week, is that my concern here and what I think is going to happen and starting to happen is an unwinding of an extremely crowded trade in both index investing, is and particularly the overconcentration of those top components like Apple, Amazon, Microsoft, Alphabet. There's so much money into those handful of stocks. And what normally happens during a corrective phase is treasuries rally, gold rallies, and then we're getting a lift today. I'm not talking one day, I'm talking a trend. We haven't seen the usual flight to safety. And another thing, and I didn't mention this on the site yesterday, but I did look over the weekend and yesterday at the put to call ratios. In previous sell-offs, I like to see extreme spikes. I haven't seen that. And what that tells me on that last leg down that we just had, there wasn't as much panic. There wasn't an extreme amount of put buying. It didn't hit the levels I like to see. Sure, there was a pop in it, but not to the levels I have. So that tells me there's not enough put protection in this market right now to put a floor. Or another way to say that, that opens the door for another waterfall sell-off if we continue to move lower here and start to go through some of these, start to see margin calls on the longs and stops hitting all that stuff. All right, so enough on that. That's where my thoughts are. So like I said, I'd have much more of a green light for a waterfall sell-off this week and next if we didn't have those big companies reporting. They don't have to hold the market up. By all means, it can go the other way, like I said, because of the correction in the market and very few risk to safety assets like treasuries and gold not really working well for especially the institutional investors like pension funds. They may need to continue to unwind their risk exposure to the market, and that could really trigger a rush for the exits in those, especially in the concentrated FANG stocks. All right, so we're looking at this chart I covered last week quite a bit. I listed four levels that stood out to me in blue here, and I covered this last week, so I won't go into detail. You can see we traded well to each one of them. We had that green candle last week and all that. And 172.50 I said was an important level. It was the bottom of this recent trading range here. You can see all those reactions on that 172.50, and then I mentioned this 171.50 is sort of and I hate to use the word line in the sand, but I colored it red and it was color coded appropriately. If we took that out, then that's where the selling would most likely start. And that's exactly what happened today. Look, we gapped down this market, and I posted this in the trading room too, and I'm going to show you the levels on NQ. You had an opportunity. We kicked back right here. This is the open right here. Move that line out of the way. And we kicked right back up there. So this was a gift to shorts. I was able to add on to my shorts there this morning, and it was also a very important level on the NQE mini futures. So, if you weren't positioned short going into the day, the train pulled back to the station. You had one last shot to load up, and yeah, we didn't hit 171.50 to the penny. As I always say, all my price targets on trades, if I'm long, I sell below the actual resistance, slightly below. And if I'm short, I'm going to cover a little bit above support. And likewise, if I'm looking to short a bounce, particularly in a bear trend, which is when you're shorting a bounce, you don't want to try to squeeze out every last cent. 171.50 is where I had it. So you want to get in early, and because if everyone's watching that level, which they obviously were, at least enough people this morning, you're going to start seeing sellers step in earlier, such as I did, and that's just something I want to point out when I mention these levels here. I don't try to squeeze out every last penny. So, all right, where we're at right now, let's go back to that level and show you. So there it is. We opened down ran up, tested it from below, and failed so far. So nothing looks good right now. To close this gap and turn the markets green from the lows today, we're talking about a 3% turnaround, not from exactly from where we're at now, but from the lows today as I grab that. So I wouldn't bank on a green close. It's not impossible, but highly improbable. So from here, where you're, depending on how you're looking, if you're bullish, I don't really have much more advice for you at this point in time. I can't give specific investment advice, but I'll just say if you're short or you want to be short, because I get that a lot. I understand people don't want to short these bounce backs because everything looks good, everybody's bullish again. But if you are looking for an objective entry, well, we already ran at 171.51. My guess, if we run back up at it again, they'll probably take it out. Yeah, I think that was the one opportunity today for a quick pullback trade. Lower your stops, trail them down. On that lot I added, I've set my stop now a little below that entry price to at least assure a small profit. And if they do run it back up, 172.50 now should be a brick wall. So let me color that a different color for you guys and just give you a level at whatever you want to make it. Well, we'll just make it a green line. Green stands out. There it is. All right, so that would be a pretty significant resistance, and then above that about 173.70 or so on QQQ. Um, don't expect it to get there, but again, with the big companies reporting, anything's possible. The bigger thing is to watch if we continue to move down, we undercut the lows from a couple weeks ago on the 11th, October 11th lows. We have already undercut those on SPY. Let's look at SPY real quick. Uh, there it is. So there's SPY. We undercut the lows, but this is a 30-minute chart, and you can see here we're starting to diverge now. We have some potential divergence. It's not a buy signal, but it could put in a tradable rally if we can confirm these divergences, meaning the PPO curls back up here soon. Levels to watch on SPY. At this point, 274.56, give or take. Maybe we'll call it 274.60, right up to about 275. Yeah, let's say 275. There it is. We're close enough. Everybody likes round numbers, so that would be your objective short entry on SPY if we bounce back there. There's a big old gap to backfill, and anything's possible. That's one thing we've seen in this market is some big intraday swings recently. Now some little bit more resistance there, about 272.40, and that was SPY on the 60-minute. There's what the 15-minute chart looks like. You had this rising wedge with negative divergence. Oh, this is nice too. This is a typical correction slash or bearish trend or bear market action. We'll just call this a bearish trend for now. So what you had there, you had a divergent high, which in a bear trend, bearish charts, I talk about this very often, bearish chart patterns have a much higher success rate than do bullish chart patterns. Just like in a bull market, the bearish patterns tend to give you the false signals and false breakdowns. And so far, that was a correction off there. We set up, and that was a rising wedge. Then we set up in this falling wedge right here. You can see bullish falling wedge, bullish divergences, and then poop, fell right out of the wedge. It wasn't even a bull trap because it didn't even break out. It just failed to play out. So that speaks to the example of how you need to be skeptical of bullish chart patterns and breakouts and things when you're in a primary, when the trend is bearish. All right, so that's 60-minute chart, SPY, same thing, potential divergences there, which is what I told you a few weeks ago. I wanted to see before considering a swing long on the indexes and a lot of other stocks. QQQ, we don't even have a divergent low yet. We still need to undercut those previous lows, but there's certainly the potential. And I think at some point soon, we will put in a divergent low on the 60-minute chart, and then I might be looking to reverse from short to long. A couple other levels to mention. I posted these throughout the day yesterday on rightsideofthechart.com. Just some beautiful levels on the Qs and all the market leading stocks. And what I was looking at is this downtrend line here. In this downtrend line, in that lowermost support line, formed a descending triangle pattern. A descending triangle pattern is inherently bearish. This one broke down to the downside, and like I said, with a what I call a gap trap, trapped a lot of longs, denying some shorts that were maybe waiting for a nice clean objective break of 172.63 to short, which is the bottom of that symmetrical or descending triangle pattern. And point is that you had the Qs were unable to break out after many attempts to get above this downtrend line. And I showed you the same thing on some of the market leading stocks. Apple was the only one it broke out, but also failed right here. And I posted this again yesterday. All these market leading stocks at 221, around 223, we'll call it. So a breakout and a failure. That was a failed breakout. That's a bear trap right there. Apple's actually flirting with some pretty key support right now around 216 as Amazon, oops, that chart was just starting to load. Amazon tried to eke above the trend line, couldn't do it, so there's another failure plus price resistance. And that's the story here, guys. A lot of these market leading stocks and the market indexes themselves have just a ton of overhead supply, meaning resistance, and that's what I've talked about here. So if this market's going to new highs, it certainly has its work cut out for it. All right, so you can see all the failures there at those 15-minute downtrend lines I'm showing you on the market leading stocks. So that's that. Let's move on and look at a couple other. All right, let us not forget the big picture. This is a 10-year weekly chart of QQQ, showing you all the divergent highs over the past decades and all the corrections. This one's still in process. I'm not even assigning a number, but we're already, I think we're, that first leg down was, I think, 10, 11% or so far. And but the important thing is here's our primary uptrend line. There's our key 40-week moving average, same as a 200-day moving average, which we are now trading below. This is a weekly chart. Today is only Tuesday. We had, as I mentioned a couple weeks ago, we were deeply below those levels, but snapped back up. So all that really matters is a weekly close. But as I said, my expectation is that we are going to break this sooner or later, sometime here in the fourth quarter. That could be this week at Friday's close, or we could bounce still and get back above those levels, but it's not looking good. Anytime you're trading below those intra-week, it doesn't look good. And although I was favoring a snapback rally here a couple weeks ago, I'm not so much at this point in time. Let's just say with those market leadings, well, you know what? They're going to have reported by Friday. We have an all clear because the last of them report, I forget who it was, a couple report on Wednesday night, and then we have one coming on Thursday or a few on Thursday night. So after Thursday after the bell, markets will do their things, have time to digest the all the earnings reports from those big companies that are coming out this week, and then Friday it's nothing but charts. Let's let the technicals play out. We'll have Apple still coming up next week, but that's just one company. And here's SPY. I mean, this chart, I'm sorry, guys. If you're bullish, it looks like death to me. There's your bull market uptrend line's a white one here. Comes off the 2009 lows. I zoom in. I had this alternative yellow uptrend line that comes off the early 2016 lows right there. Both of those. That one broke down earlier in the year, back tested all along for months. That gave way. The primary bull market uptrend line off the 2009 lows broke. We had a stick save or printed right, yeah, stick save a few weeks ago, like I expected. Parked it right back on the 40-week and the trend line. The following week closed below the primary uptrend line, right on the 40-week. And today, the 40-week and the trend line, they're starting to put some distance between it with this big red candle. Another thing I mentioned on the site, not to just go all over the place today, but I believe these are important, very important developments. I mentioned the stark underperformance of the financials yesterday. XLF was down big again today. You got to ask yourself what's going on with the bank stocks, BKX, yeah, bank sector. This is the, these are the large banks. Here's a bank sector in free fall recently. We all know what's happened in housing. It's another thing I mentioned. So here's the key pillars of our, economy. Housing is a big part. The things that the two things that really, dictate consumer confidence are the stock market and housing. Your house price goes down. If your 401k is booming, okay. But when they're both dropping, you're going to see consumer confidence fall off a cliff. Therefore, economic expectations go down. This just isn't good any way you want to spin it. And then you look at the regional banks. KRE is one of the regional bank ETFs. I pointed this out yesterday. This is a waterfall sell-off in the regional bank sector. You have to ask yourself what's going on. Is this just a regular stock market correction? It started out as a little tech wreck in the FANG stocks, but it's bled over into the financials. Just food for thought there. Okay, and then finally, to wrap this video up, let's look at the futures real quick for both future traders and for three reasons. Futures traders or those that like to chart the futures because it tells you a different story. It's giving you additional information. It's like having wearing polarized glasses. If you go out fishing, you can see through the water. You can see things you can't normally see without the polarized glasses. Um, and I like that same thing in the futures because I can see trend lines developing and other horizontal levels of price support and resistance that you might not be able to pick up so easily on QQQ. And the reason I like trading the futures is you don't get caught in a gap down. If you trade QQQ or SQQQ or any of those derivatives, the leveraged ETFs, and you go home short or long, here's what happens to you. You have a big gap down like this that you cannot control. Stop loss orders are bypassed. There are only two types of stop loss orders. Oh, well, the two popular ones, stop limit and stop loss. A stop loss is executed at the market open along with all the other orders, no matter how far. Your market can gap down 6%. Your stop could have been a 0.5% below where you closed the day before. Guess what's happened? It's going to fill at 6% loss. It's going to execute at the open. Or you can put in a stop limit order, 0.5% below. But when the market opens, guess what happens? Nothing. It doesn't get filled. That stop limit order will only get filled at the price that you set it at. So you can then watch the market drop another 10, 20% from where you are and just walk away and let your losses rack up. So, with futures, since they trade virtually around the clock, you're going to see those movements and, your stop losses. There's so much liquidity. They'll get hit after hours and you get taken out. Or you can also jump back in when you see a breakdown because that's what I've noticed. A lot of these breakdowns occur and breakouts occur before the stock market opens. And I'm going to show you a few charts and some levels to watch for you NQ traders. We'll start with this was October 31st. This was Sunday night. I was in the trading room. I'm usually not that active at night, but about, let's see, it's time stamped 8:40. And I mentioned that the market had fallen to a key support level. I added these support levels on NQ and ES. It's 70, 57, 50 on NQ right there. We were at it. I said we either rally or break down, but I think that's an important level. The next chart, the next update was the following day. We certainly did. You can see we bounced right off that level, and then I added two additional resistance levels where I expected a reversal. Again, all these posted in the trading room. 71, 73, 80 price resistance right there, plus the downtrend line. And you can see what happened since then. This is from this morning. Perfect. We popped a little above the 71, 73, 80, but failed at that downtrend line. Then went on, and we went on to break down below this level. So where are we at right now? Let me find that chart for you. There it is. That was Sunday night right there. There's our bounce off support, key level right here. Bounced and failed at resistance. And then this morning we broke down. And again, I showed you earlier, we were down at the open, but we rallied right back up, right just below, a hair below that 70, 57, 50 level, and then turned back down. So now that's, again, I'm giving you these because that's still a level that we need to recover. Bullish, if we recover that, it is comparable to that level on QQQ I just showed you earlier on the intraday chart. So that's the level right now the bulls need to take back. And there's also this downtrend line. We can extend that as well. So there's your level for NQ traders, levels to watch. And, any big rally, let's say some of these FANG stocks blow it out of the water and we get a post earnings rally. This 71, 73.80 level still looks, give or take, still looks like very significant resistance up there. But again, you can't rule out if we keep moving lower, we take out these lows. We could get that waterfall type sell off, but I'm on the fence with those, big FANG stocks reporting this week. I wish I could say with conviction, but I can say this. If you're short and you've been short this trend, you had a good opportunity to short back here on the bounce cover here, a couple weeks ago when we were expecting to bounce. Swing shorts look fine. They're not even in jeopardy at all of being taken out right now. If you start to get over those levels I mentioned, these uppermost bounce levels, then that might be a different story. But as of now, swing shorts look good. Okay, we'll wrap up with ES because this is where this has actually been interesting recently. It was, tech was leading on the way down, as was to be expected. There's just too much money crammed into too much love in the FANG stocks, and so there was, some unwinding of that trade. It's just too concentrated. It's dangerous especially for, institutions and pension plans and all that that are you get a rush for the exits, and it doesn't fundamentals don't matter at that point. If everybody's trying to get out of the same stocks at once, it's going to lead to a pretty swift sell-off. But this is ES. This is again Sunday night around 8:40 p.m. Eastern time. There was that right when NQ had hit that level I showed you. ES had fallen also to 27.49, pretty significant level. And again, I'm studying the charts. That's where I thought it was a important level. And I also mentioned a bullish on both of those bullish divergence, little small divergences. And so from there, that was Sunday night. We played out. We got the pop following day, and this is where I gave a downtrend line 279. That's 279.80 rounded off there, and 279. Yeah, 2780. Sorry, 2780, give or take, right there. And that looked like a good reversal point. And there it was, right there at that same level. That chart, that's where we reversed right after I posted that chart. We went on to break 2749, and look what happened. So it goes to show, this was even more so than NQ, a very key level for ES. Once ES broke that level, as you can see, waterfall sell-off. And so that brings us to where we are now, and we'll wrap up with this last chart. Where are we at now with the ES? There we go. This is a live 60-minute chart, kind of give you an idea where we're at. So there's, we don't have, I showed you the divergence on the 60-minute chart, potential divergence for NQ or QQQ and I believe SPY, but we don't even have it close to divergence yet on ES. In fact, we could later on. I'm sorry, we do have divergence, but it's not confirmed, is what I meant to say. We're still pointing down. So there is divergence, but it's not confirmed divergence. Those indicators are heading lower. If we reverse, that could be it. If these divergences are confirmed, I really like to see those 60-minute divergences set up for a swing low. So we're not, like I said, we may be close. We're very close to that POR or WTF moment, point of recognition. And I wish I could give you, with a high degree of confidence whether we're going to get it. But like I said, with those big FANG stocks reporting this week, this market could get a little jolt here. If it does, I'm giving you resistance levels. These divergences don't have to play out. The trend since early October has been bearish, so you have to be suspect of these divergences here. If they do play out, there's your bounce targets. That same level, 27.49 or so on ES. There's a downtrend line that comes in right around that same level, so that would certainly be an objective level to short. And if it breaks out and these divergences are firmed up, that could be an objective level to go long. We'll see. So that's where we're at. We're at a pretty significant inflection point. If you're an active trader, there's a lot of money to be made in these markets, but if that's not your cup of tea, you'll get chopped to pieces. These reversals are swift. We saw pointed out, it was, I think, over a 2.5% rip in Amazon yesterday in just 20 minutes. High frequency trading was straight up, virtually straight up. And you've seen those rips faded, and that's the nature of this beast. So this will chop the unexperienced, less active trader to pieces. But if you look at the big picture, everything I started the video with, the daily and weekly charts, I still think there's more downside to this market, and probably to the tune of about 10-11% or more on QQQ, a little less than that on SPY, and that's before all is said and done. No matter what happens over the next week or so with the FANG stocks, maybe they need to get their earnings out of the way first, maybe not. We'll see. We'll wrap it up here. You have the key levels to watch, and if anything changes, I'll be sure to do an update as soon as possible. This has been Randy Finney with the right side of the chart.